The European Central Bank has dished out yet another big rate increase. It's lifted interest rates by another 75 basis points. That is the highest in more than a decade. The move, it hopes, will help it tackle record eurozone inflation and a looming recession. Just last month, the ECB made a similar move, bringing borrowing costs to the highest since early 2009. Now for more, Rosie Burchard joins us live from Brussels. Rosie, a very big jump, but tell us more about the reasoning behind the central bank's consecutive rate hike.
The European Central Bank really fighting for its reputation here as an inflation buster. Let's not forget the European Central Bank's main mandate. Its purpose is price stability, and inflation in the eurozone is currently running very hot, just shy of 10%. That is about 5 times higher than the ECB's target of 2%. So the ECB now looking into its toolbox, and of course it sees interest rate rises as a way to drive down inflation. But of course it is here walking a difficult tightrope and a narrowing tightrope as it's balancing risks of tipping the eurozone into recession. And certainly plenty of economists do think that a recession now is on the cards for the eurozone. The ECB here is, however, seen by some as playing catch up to some extent. We have seen 3 consecutive rate rises from the ECB since July, but prior to that, they had not raised interest rates in about a decade. So they started these rate hikes later, and they were certainly less aggressive than some other central banks, for example, the US Federal Reserve or the Bank of England. Now, the ECB says in its latest release that the Governing Council expects further interest rate rises, but that they will do so according to evolving inflation, and they will continue to follow what they call a meeting-by-meeting approach. That is to say, they will not tell us by how much and when they will next raise interest rates, but they say more interest rate rises are on the cards as they fight to tame this runaway inflation across the eurozone.
Well, meantime, Rosie, the sudden rise in borrowing costs, that's left the ECB facing this tricky decision on trillions of euros that are in liquidity. What are the implications for the transmission of ECB policy, though, for money markets?
Well, this is a problem the ECB has been facing, because while it's been raising interest rates, well, that's created some kind of monetary policy dissonances. And now they are trying to set that right by pulling the different levers of their monetary policy. Now, over the past few years, the ECB has been offering ultra cheap long-term loans to banks to help the eurozone weather several crises. But now, because of these interest rate rises, lenders can simply park that excess cash from those loans at the ECB and profit or pocket from the higher deposit rate. So the ECB now says that it is trying to change that, and according to the latest monetary policy decisions, the ECB says it will change the terms and conditions of these longer-term loans. During the acute phase of the pandemic, the ECB says this instrument played a key role in countering downside risks to price stability, but today, they say, in view of this unexpected and extraordinary rise in inflation, it needs to be recalibrated to ensure that it is consistent with the broader monetary policy normalization process. So therefore, it's decided to adjust the interest rates applicable to these loans from the 23rd of November 2022. However, the ECB says that later today it will give some more clarity on exactly what it's changing in terms of the terms and conditions for those loans. But of course, this is something that will ECB and monetary policy watchers will be looking at closely to see what kind of impact it's going to have on money market spreads.
Investors and markets are going to be waiting with bated breath for that news. Rosie, thank you very much for that. Rosie Burchard there in Brussels.